Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Today I'm looking at Chewy Inc. They just had their earnings call on the 6th, so I'm going to post this on the 8th. And the earnings were okay-ish, kind of mediocre. Initially, the market didn't like them. The stock was down close to 10%, maybe even a bit more when the market opened. But then it kind of recovered as more people digested the news, as the earnings call happened, some more info was given. These guys have an investor day in the next week or so that I think is going to be very interesting. But I kind of wanted to take a look at this today to see if it's something I want to add to my list, because this is a stock I'm familiar with. It's a stock I owned a couple of years ago. They IPO'd in 2019. I think the IPO price was 22 bucks. They opened at 34 bucks, fell a little bit. But then the pandemic hit, and this stock and a lot of pet stocks, whether it's Pet Meds, Trupanion, Freshpet, really benefited from the pandemic because people were stuck at home. They wanted companionship. They bought pets. They adopted pets. They did whatever. And when that happened, they needed to buy things for those pets. And Chewy really took off. I think 2021 had something like 48% growth. And now that growth is kind of coming to an end. And once that growth story really ends, the valuations can come off a cliff, and that's really what happened here. I owned this maybe somewhere around this range. I really got out well before the top. I owned Trupanion at the same time. I owned Pet Meds at the same time. I owned IDEXX. I owned Zoetis. I had a big pets portfolio. At this point, I only owned Zoetis and IDEXX. Those are the guys that actually make vaccines, medicines, etc., that your vet uses. They're a higher margin business. Still a pretty good long-term business in my mind. Have done very well on those stocks. But now that Chewy has really crapped the bed, as they say, in the business, it's starting to get interesting again in my mind, because this is a business that's basically at its all-time lows, but probably in the best spot it's ever been in terms of margins, in terms of their business model, in terms of what they're doing, in terms of their balance sheet. So it's starting to get interesting, and I was kind of hoping it would stay down all day, because this is a stock I probably want to get into if it's at the right price. So we'll see what kind the right price is. So we'll look at the Q3 earnings themselves. Well, net sales were up about 8%. Not bad, but certainly slowing when you think about their historical growth in the last couple of years. Another issue is that active customers are actually down year over year. And this is a company that spends, 200 million, close to 200 million a quarter on marketing and advertising. So to see that number come down really speaks to the fact that pet adoptions are down, that people are being more careful with their wallets, that they're not taking on new pets, which is a bummer because pets are awesome. I used to have a dog, don't anymore. Rest in peace, Teddy. Great dog. She was the best. I still have a rabbit, for example. I did use Chewy. The reason I liked the company is that it's great. It's a great business for consumers. So I could go to my vet, and my dog was on vet prescribed dog food. I could get that dog food at my vet. 30-pound bag was like 90 bucks. Or I could go online on Chewy, have that same dog food shipped to my home for $85 and get free shipping. So I was like, that's awesome. On the other side, as an investor in the business, as it kept going up and up and up, and I was looking at their financials, I was like, this business model sucks. They're sending me 30 pounds of food every month at a lower cost than I could get on the retail side, and they're not charging me for shipping. How the hell are they making money? Now, the idea is that, yeah, they might be losing money on the big bags of pet food that they ship to you. But then when you want to buy some treats, or when you want to buy a dog bed, or when you want to buy some toys, you go to Chewy, and those are far less costly to ship. They have far better margins on those, and they make money on that. On top of that, they have a pharmacy, an in-house pharmacy that is now $1 billion a year business, and that has bigger margins too. If you think about PetMed Express, which is another stock that's basically 1-800-PETS or whatever their website is, 1-800-PET-MEDS. That business kind of has, 9 to 12% EBITDA margins, maybe even higher, maybe closer to 15% EBITDA margins in a good year, 9 to 10% free cash flow margins. So when you're talking about 10% of your business now being that pharmacy side, which has a better margin, as that grows and is growing at a faster clip than their retail business, that's going to improve margins. On top of that, they're investing some money into expansion. They're moving into Canada, which is why their net income is a bit lower than it was expected to be, why their net margin is in the negatives, a bit lower than it was expected to be. They're investing in additional fulfillment centers. I believe they opened one up in Nashville and Reno this quarter. And that all costs money and it impacts their bottom line. On top of that, they are still quite heavy on stock-based compensation, which is a negative in terms of future dilution for shareholders, but it is a non-cash expense. It does negatively impact your net income, but it is a non-cash expense, which means that even though their net income is negative, their free cash flow is actually positive, which is kind of a cool thing from the perspective of me as an investor, because when I owned the stock, yeah, it was growing fast, but it was burning some money. It wasn't burning a ton of money, but it was just not making any money. Now they're actually making money. So even though they're sending you 30-pound bags of food for free, they're actually somehow making money out of that. So now the business is starting to get a bit more interesting. And the cool thing about this business is that it's in some way recurring. The revenue is recurring in nature because so they make about $540 per customer, which is pretty solid. And on top of that, 76% of their revenue is off of auto ship sales. And auto ship is basically I'm going to sign up for reoccurring shipments of dog food, of medication, of whatever. And when I had my dog, as she got older, she was on medication that got through Chewy's. When I had my prescription food, that was on auto ship through Chewy. So all of that stuff was coming in automatically. And again, they were probably making a little bit of money off of me because of the RX side, but that's the long-term game plan here, right? You come in as a customer who sees that, hey, I can get food shipped at basically the same or lower cost than at retail, and it's free and it's automatic. That's pretty cool. And in the future, maybe if my dog needs a prescription, I'll get it filled at Chewy's and I'll make more money off that. If I want to buy some toys, etc., do it at Chewy's, yada, 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 all of that stuff. So that's the idea with this investment. That's the goal as an investor, that you would have that long term. You're talking about a business that currently has really tiny margins. You're talking about 2 to 3% free cash flow margins, which isn't a lot, but with retail, that's kind of what you expect. And as they grow their pharmacy business, as maybe this Petabyte acquisition that is in the software to veterinarian sector grows, they just made that acquisition for $40 million. They are probably going to make more acquisitions because they have a pretty good balance sheet with $1 billion on the books. If they want to expand the pharmacy, maybe they acquire Pet Meds Express. If they want to expand their insurance business, maybe they acquire Trupanion. I think Trupanion is actually a bit more expensive than they'd probably want to pay. It's somewhere in that 1.2 billion market cap range, so they'd probably have to pay closer to 2 billion or something like that. And if you look at Pet Meds Express, a stock that's done terribly, but it is a free cash flow generating business, that it's not growing, it's shrinking, but it would add free cash flow to their business and improve their margins right away, even though it's a shrinking business. So maybe it's not the worst buy to have, and it's something to keep in mind. So the other negative thing about this earnings report is the slowing growth. So they basically announced that, hey, our Q4 revenue here, the expectations are we were going to be in the 2.9 billion range as a company. We're actually going to be in the $2.8 billion range. So the investment community kind of expected 7 to 8% growth for the next quarter. It's actually going to be closer to 3% growth, and the expectations were closer to 12% growth for the year. It's actually going to be about 10% growth. And again, they're blaming that on macroeconomics. They're blaming that on the fact that adoptions are down 14 to 16%, and that doesn't translate into new customers, because if people aren't adopting dogs and cats and other pets, then they're not coming to us, and there's always going to be some rollover from older customers who are leaving for one reason or another, and we need to get new customers on board, and that's not happening when people aren't adopting pets. And on top of that, stuff is expensive. So maybe people are cutting back on treats, maybe people are cutting back on toys, and obviously people are cutting back on adoptions because unfortunately they cannot afford it. And like I said, that is a bummer because pets are freaking awesome. So again, looking back at the story here, why the stock was up as much as it was 47% growth, 24% growth, 13% growth. It's kind of slowing down to 10% growth. Next year is probably not going to be that great either. If you're talking about a slowing marketplace, even if they're expanding to Canada, that might be tough to do. 6% growth is expected for 2025. I'm not really looking out to 26, 27, or 28. I would expect that growth to slow as well. But my thesis would be that EBITDA margins are improving. And in order for this investment to play out well in the next couple of years, they have to keep on improving. So my goal as an investor would be to get these margins into that 5 to 6% range, because that would mean free cash flow margins into that 4 to 4.5% range. And as we look at the financials here, quick disclaimer, video is for informational, educational, and entertainment purposes only. It is not investment advice. Do your own due diligence before making any investment decisions. So I have my handy dandy spreadsheet over here, and you can kind of see what we've seen here. This is an $8.3 billion market cap business. The debt position is fantastic. Again, this is net debt. It includes capital leases, which aren't really that draining as far as debt goes. So they have about $1 billion in actual cash on the books, about $500 to $600 million in capital leases. They have done a pretty good job of being capital stewards. This is their IPO money that they gained in 2020. They issued additional shares at $55, which was 300 some odd million that they raised to add to their coffers, which was a good time to do it now that the stock is trading at 18 bucks. Clearly a good move. Hopefully they don't have to raise money anytime soon, which they shouldn't, given that they have almost $1 billion on the books with no actual debt. And they've also issued stock-based compensation. So even if they're not issuing actual shares, there's still stock-based compensation in the neighborhood of 70 to 150 million. That seems to be going up recently, which is not a good thing because that's always dilutive. So that's a bit of a bummer. They do not pay a dividend. So my assumption here is that, yes, growth is going to slow. I'm being a bit optimistic here about their expansion into Canada, all of that stuff. About 10% growth for 24. We'll probably get more guidance into what's going on in fiscal year 25, maybe at Investor Day. So maybe some more clarity there. I'm assuming 9%, which is a bit higher than the 8% they have here than the 6% the market has over there. So you're talking about probably a bit of optimism on the growth here. Maybe I'll kind of tone it down to 8% to be a bit more realistic. And then I'm assuming a little bit of growth on the margin side every single year, kind of getting to that 4%, just shy of 4% growth, 4% margin by 2028, fiscal year 2028, which is about $500 million in free cash flow. Now that is free cash flow that includes quite a bit of stock-based compensation. So it's not like true free cash flow because it does dilute the owner of the stock because of the stock-based compensation. But I'm accounting for that with a negative buyback. So I'm basically saying that there's going to be about 650 million in stock-based compensation that is going to have a negative buyback yield for the investor. And a stock like this that's kind of slowing in growth, maybe I'm being a bit optimistic here, but if you kind of think about what their expected free cash flow is for 2024, fiscal year 2024, we're talking about 3.6%. That's how the market is pricing it today. Because of the slowing growth, I'm kind of assuming that it's going to be closer to about 5% as a free cash flow yield by 2028. So I'm putting 25% weighting on 4% free cash flow yield, 75% weighting on 5% free cash flow yield. And with that in mind, at today's price point at the 1923, you're talking about an expected return of about 6.7% with all of these assumptions in mind. Now, they could do things here that help that. They have a ton of money. They could make acquisition that spur growth again, that improve their margins. They could be more effective in their cost cutting. They already had some layoffs not too long ago that is going to help improve margins. It's unfortunate that that's how things work, but that's kind of how businesses work. Again, this is targeting a 10% return here. If you want to make this a good investment at today's price point, I think given the assumptions I have in here and a target return of 10%, I'm looking at a fair value of about $16.66, which isn't too far off today's price, about 13.4%. The stock price was basically close to 17 bucks this morning. So if you're getting in at that price point, you were sort of doing a good job given these mechanics here. Now, if you're looking for a higher return here, given that this is a riskier stock, given that this is an online retailer and there's always the specter of Amazon with online retailers, you might be looking for a 15% target return, kind of gets you down to a $13 fair value. Again, it's really up to you to decide how comfortable you are, what kind of margin of safety you're looking for. The idea here for me in order to be comfortable with this price point, I would have to assume that either they're going to start doing buybacks or they're going to make an acquisition that is going to be a bit more transformative in terms of their margin profile. I'd have to hit something like 4.5% margins by 2028, which isn't crazy, but it's also not what they've shown. And I think there's going to be more information that we're going to get about their health aspirations on the investor day in a couple of weeks. Again, their pharmacy is scaling. It is a higher margin business. They've made those acquisitions on the software as a service side. They have an insurance business that they're working on with Trupanion and Lemonade that's probably expanding. But again, Trupanion doesn't necessarily have a ton of margin either. So that's not really a huge high margin business yet. Is Canada going to be a margin expansion? Probably not anywhere close in the near term. So I think even the 3.9 is a bit of an optimistic view of this. And for me, this is an intriguing stock. It's getting to a point where it's kind of interesting, but at $19, it just doesn't feel like a great deal unless you think that margin expansion is coming, unless you think that growth is going to pick up again. Because from what they've shown right now, especially if the economy slows down a little bit, margins are going to be tight, and they've always been tight with this company. And again, these free cash flow margins are really driven by non-cash stock-based compensation. So you have to make sure that you account for that with a negative buyback yield. You have to assume that growth is going to slow if you're expecting the economy to slow, if you're expecting pet adoptions to be pressured. And I think that's realistic. You know, if it turns out the other way, if their health aspirations turn out to be good, if their margins expand, yeah, today's price point isn't too bad. And I think even with these assumptions here, I think today's price point still is going to be a positive return. It's certainly a lot more intriguing than it was when it was trading at $50, because this was always going to happen. This was not a stock that was going to trade as if it was going to grow at 20 to 30% every single year. It just kind of has an end point, and it's reaching that maturity point sooner than people expected, and that's why the stock is down so much. So those are my thoughts on it. I think I am going to add this to my watch list at about $16 to $17. That's kind of where I would be interested in starting a position. If you already have a position now, if you started a position this morning, or if you're even starting a position at $19, I think that's not terrible. It's just I would want something more, because I think this is probably a riskier stock than most that I've reviewed on this channel. There's a lot of uncertainties around their growth potential, especially with the earnings announcement today and the fact that it's slowing already more so than the market expected. That there's investments into unknown areas that may put pressure on margins. But on the other end, balance sheet looks good. This is a company that can withstand some investment years, and they're doing that now. They can make some acquisitions that could be pretty good. They could buy back shares to kind of help with this negative buyback yield. And they could make investments in fulfillment centers and expansion into other markets. Canada's number one. Is Mexico next? Who knows? There's always competition out there, but Chewy is sort of the best of breed when it comes to online food retailers, pet food retailers. I feel that way. A lot of other people feel that way. As long as their quality of product continues to be really good, as long as they don't skimp on that, I think this has potential. It's just not quite there for me on the price side. So let me know what you guys think about Chewy. If you're an owner, if you're interested in buying it, if the price point's right for you. As always, guys, if you have any comments, leave them down below. Like the video if you enjoyed it. Subscribe if you're new to the channel. Welcome back if you're not. Hope you liked the video. Let me know what you think. Bye.